Good evening and welcome to tonight's webinar, member-only content, where we look at ASX investment opportunities in review for the 5th of April. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service. If you'd like to discuss how that works, please contact me on 1300 614 002. The technology we're using tonight is the Investor Signals member area. If you're joining us as part of your 30-day trial, just as a reminder, you can subscribe to the service for $1,320 for the year. The graph up on screen is the Nasdaq. It's under a continuation of the strong uptrend that's occurred post the March sell-off. We've had in excess of a 100% rally from those lows in March, and now what we're seeing is a sell-off of roughly 10% and a recovery back up towards that prior high. So we'll watch the Nasdaq with interest this week to see whether that momentum above the moving average can continue, and the type of names that you're going to need to see: Qualcomm, Intel, some of these chip makers continue to perform well as well, things Amazon. So some of the large cap tech stocks that are interestingly under algorithm buy signals, where during this sell-off they've had a higher low formation, a new buy signal. Some of those I've commented on the blog, but we give a little bit of upside momentum, the opportunity in those names, but still remain cautious that the high PE valuations are at risk of the Nasdaq rolling over and forming a lower high below that, below the high from a month or two back. With that, let's take a look at the ASX stocks this evening that we want to focus on. Starting with the stocks, just doing something different this evening rather than toggling through the ASX 100. I'm just going to focus on a couple of lists. So first here is the high conviction A2 Milk. If you're not already set in this position, or even maybe you are and you're just looking for a short-term trading opportunity this week, watch this for a break above that moving average. So if we see the stock price start to move above the average, there could be a trading opportunity there in A2 Milk. Amcor, we like this. It's probably one of the more overweight positions in our portfolios. It's rallied from around $14 up to $15.50. It has the potential to trade up to around $16.50, whether we head there in a straight line or we pause around this $15.50 level. So depending on what your portfolio requirements are, you could think about selling covered calls here to drive extra income, but ultimately, the uptrends forming as anticipated off that $14 support level, and the fundamentals support a higher share price there. APA is a stock that we liked based on a sort of defensive infrastructure earnings stream, offering just around 5% dividend yield, but it has switched to algorithm sell signals, so we start to take a little bit more of a cautious view here on APA and sort of review whether there's better alternatives for allocating that capital elsewhere in the market into opportunities that are under buy signals. ASX I like, recognise there's not much in the way of revenue growth, 3.5% dividend yield, so it should be a slow, steady recovery from here. At around $71 seems good value on a risk-reward basis. Brambles is under a lower high pattern, and we don't very often hold or buy stocks that are under the algorithm sell signal, so meaning that the primary signal is the sell signal up the top here, whereas obviously that's the buy signal. So given that the most recent signals sell, which is just reflective of the stock making lower lows and lower highs. But the reason why we're attracted to this, the company's guided towards that 5% earnings growth, roughly nearing on 3% dividend yield, and has the potential really to trade back up to around that $11.50, $12. So we stay long Brambles at the moment. Car sales is an opportunity that if you're not already in this from the end of last week, you can think about that this week. The stock's corrected from 23 down to 17. It's bounced from 17 up to 18, but we added that into portfolios late last week. CIMIC Group, a little like A2 Milk. I think it's time to start having a look at this from a counter trend standpoint. It could be getting oversold. It wasn't Friday, on Thursday we started to see the stock price close above the average. So a little like A2 Milk, if you're looking for a short-term trade, think about this. Run a stop loss if it closes below the average, shut the position out. I'll endeavour to put up on the blog tomorrow an option strategy which gives you the upside of the shareholding exposure but limits your downside. So I'll see if I can put together a payoff diagram on at least one option strategy around CIMIC just as a point of interest, and we'll continue to monitor how that goes over the coming weeks. CNU is a ETF giving exposure to China, so I like this. It's rallied from 8 up to 850. The momentum there should carry that higher. Coles, not much in the... Well, it's worth just recognising not much in the way of earnings is really not correct here. Woolworths delivered low teens, I think it's somewhere around 11, 12, 13% earnings growth. Coles is likely to deliver something more in the order of 5 to 7% going forward. Woolworths probably on a forward basis delivers high single digit earnings growth. So they're still attractive on a 3% plus fully franked dividend yield, but obviously the issue is it appears that earnings are slowing down from the peak levels of the first half, or I should say of the second half of calendar year 2020, the first half financial year. So over the next 6 months, we expect to see slightly softer numbers out of Coles and Woolworths, but still attractive. So when I think about Coles, to me, it's an opportunity to buy it and sell covered calls and drive that 8 to 10% cash flow out of it. CSL, buy this on the dip. If we see a retest back down to around that 250 level, we're buyers of that again. Cure, I like this in portfolio, so I flagged this on the blog last week. It's rallied from $64, $65 back up to 68. I wouldn't be surprised to see this capture new highs over the next 6 months, so we're buyers of that on the dip down here. Cleanaway, really make a note of this. At around 220, it's good value. If we saw it into that price range that I've marked out there and it happened to trade down around 210, it really sort of then becomes a really a strong high conviction opportunity in the market. As I've discussed in previous weeks, the opportunity here to keep an eye on Cleanaway is the acquisition of Sue's Waste Management. It's a $3 billion acquisition. And it's a potential significant earnings changer for Cleanaway from low single digits with cost synergies that they'll be able to extract. It may create a more exciting story over the next 12-24 months for Cleanaway. But regardless whether that acquisition goes ahead, we're a buyer of Cleanaway on any weakness, so the correction from 270 down to 220 is a buying opportunity. Downer EDI, I like this, supported around $5. Forward earnings growth likely to be in high single digits. So, that's a buying opportunity, as is CIMIC. Fisher and Paykel, we liked. I'd flag this as a buying opportunity at around 25, back up at about $30. Is pretty close to fair value or where it's likely to consolidate. GDX closed strong on Thursday. We saw gold up a little in the US as well, back up around $17.30 US an ounce. So hopefully we're in a position where we start to see better price performance out of GDX miners and the gold stocks that we cover. Within the ETF market, still in the high conviction portfolio, is GOAT, which is a effectively large cap stocks that have a protective moat around their earnings. This gives exposure to those businesses excluding Australia, and that's performed well. Obviously these yellow markers here are when I started talking about it on the blog at $20, now trading 22. Should continue to push a little bit higher. Gold Road Resources, part of our gold basket trade, so continue to like that, buy that at around this 112 level. Ishares Global Consumer Staples, this has now rallied almost 10% from those lows, still has further upside, consolidation level back up at around $78, $79, so we continue to hold that. Likewise with the healthcare, although this has switched now to algorithm sell signals, so we may see it run into resistance around that 102 to 105 level. Lendlease, good recovery opportunity, tough earnings picture in the current results, but if you can look past that, we're likely to see much better numbers out of Lendlease over the next 2 to 3 years. BetaShare Global Gold Miners, buy that on the dip as an alternative to owning individual stocks. Moat, so this is the global strategy to large cap Moat stocks, it's corrected from 85 down to say 78, switched to algorithm buy signals there, and now it's trading $91. So we continue to like that as an opportunity. The market vector, so this is an alternative to the SLF that I've been talking about, but gives you broad exposure to Australian REITs. So thinking that support develops there around $20. But the picture's not particularly exciting, I think, for REITs. Where there is above average earnings growth remains Goodman Group, and if you want to complement that REIT exposure, you can think about the SLF or the market vector one. Newcrest Mining support here at around 22, now pushing 25. We think that there's a place for that in portfolios. As with Northern Star, we like that, sub $10 offers value. ResMed switched to algorithm buy conditions, created the higher low there around 23, 24, now pushing 25. Will be interesting to review their earnings results over the next couple of weeks. Resolute Mining's been a little bit disappointed. We're thinking that it was support there at around 60 cents. It's broken lower to 45. But obviously all the gold stocks have been under pressure. Sonic Healthcare, we're taking profit on this. It's rallied from our support of 30 back up to 35, 36. Don't see any downside risks in Sonic, so it's kind of marginal if you want to take profit or maybe sell covered calls, but we just think at $35 it's close to full value at the moment. SNAS is really something to have a look at if we see the Nasdaq index break below that 10-day average. I'll draw your attention to a opportunity there in the short Nasdaq if the technical setup supports it. Transurban, we like this as a recovery play within the infrastructure sector. Maybe fair value for that could be back up at around $14, but not too much in the way of visibility right at the moment with what that the time frame obviously for a return to normal traffic conditions. TPG, the CEO or chairman stepped down. There's a bit of a risk of the overhang of shares that he holds if he was to try to look for a sale or disposal of those, but otherwise, based on the current financials, TPG's really bumping sideways. Analysts have pretty bullish outlook on TPG though. They do see a significant acceleration in earnings over the next 2 to 3 years, partly supported by the cost synergies post Vodafone. WDIV is the global dividend fund, so we like this. It's already rallied from 16 up to 17.50, but continue to stick with that. Wesfarmers, high quality business, attracted to the combination of Wesfarmers, Bunnings, Officeworks, Catch, as well as some of their industrial aspects of the business. But certainly that e-commerce leverage play using Catch and the expanding product offerings through Bunnings and Officeworks. We continue to sort of be mindful that it does trade on a fairly high PE, but 100% fully franked dividend, double-digit earnings growth still remains attractive. Woolworths attracted to this, buyers of it on the dip down here to $38, as I've discussed in previous weeks, offering the added benefit of the spin-off of Endeavour Drink. Back up at around $41, $42 would be pretty close to full value there for Woolworths. Woodside, buy this on the dip, maybe $23.50 to $24 is the buy range there on Woodside. If you want to be patient, you can wait for a close above that moving average, but continue to think that offers an opportunity. Xero we like. In some ways this has already moved sort of from where our entry level was. I flagged it on the blog down here around 110, now pushing 130, remains above the moving average, and there we are back to A2 milk. Just to have a look at the blog posts that we've covered, so going into watch list, coming down here and selecting recent blog posts. And this is really just designed for tonight, as I said, something different rather than just covering the top 100. I just want to go in and we'll revisit the most recent stocks that have been the focus of the blog, and some of them, as you would expect, are holdings in the high conviction portfolio. But just to recap some opportunities that you want to be thinking about in the market tomorrow. A2 milk, keep an eye on this for a cross above the average. Amcor, if you don't own it, no problem buying it here. Ultimate upside to 16.50, or you could buy it and sell covered calls over it. ASX, we continue to like that as a high quality holding in portfolios. Beach, my preference is Woodside over Beach, but the outlook for Beach still remains attractive. Car sales, we were buying that at the end of last week. Coles, happy to buy this and sell covered calls over it. Cleanaway, we've been buying that on the close on Thursday. Continue to add to that position this week if we see any softness below 220. Fisher and Paykel really sort of done and dusted a bit there. The rally from $25 to $30 captures what we think is fair value, but ultimately, terrific business, growing earnings almost around 30% over the last 6 months on the same time 6 months prior, but it is on a high PE as I've discussed. Fisher and Paykel. Goodman Group, high quality property trust, switched to algorithm buy signals at 16, now pushing up to 18, maybe a little bit left in it but not too much. Gold Roads we think is a good buying opportunity for exposure to the gold play, as is Newcrest and Northern Star. Cube, we're not overweight Cube at the moment in portfolios. It is in the model. If we saw a pullback to around that 275, I'd be a strong buyer of it. The forward, certainly the freight numbers through our ports at the moment are up somewhere between 7 to 13% on the same time last year, which should bode well for Cube earnings, but it is slightly on the expensive side. Rio, we've seen a number of analysts downgrade the outlook for iron ore, so we're at about 160 a tonne at the moment, and a number of analysts have much lower spot prices in their models, so back down at around $90, and that's really predicated on a slowdown in Chinese steel manufacturing, which is kind of a bit counter to, if you like, to some of the headlines around obviously the infrastructure plan in the US and some of the optimism around the market at the moment. That and remembering partly why iron ore's up at 160 a tonne is the supply that came off the market with the issues in Brazil. And they're likely to be resolved, so we're likely to see more supply coming onto the market over the next 12 months. In saying that, we're still willing to be a buyer of Rio and Fortescue on this sell-off. We've seen a correction from 130 down to 100, slight bounce higher, but maybe it's one you have a think about running stop losses on a break below that 104 level. Sonic, as I discussed earlier, up against resistance and maybe think about taking profit or sell covered calls. Transurban, buy this, look for a slow recovery. Woodside, buy this on anything below $24. Zero probably trades up to 130, 140, and I don't think the sell-off, even in a correction in the Nasdaq, takes Zero back down below that 104 level. So any pullback, I'd be a buyer of the dip in Zero. And there we are, back to A2 Milk. Just as a reminder, the Cure ETF, we covered this earlier, but at around this $64, this is forming a good base here, and I think the fundamentals there are in place for the biotech stocks to continue to perform in the US. So if we look at this over a longer term pattern, we have a good structure of higher highs and higher lows. The pullback sort of come back to that prior high there of mid $60, bounced off support of 63, and I'd expect to see over the coming months that that structure to hold and higher values to be presented in maybe in the middle to back half of this year. And just to conclude, for those looking for the trading opportunities, keep an eye on CIMIC. The thinking here is the last earnings result for the 6 months to December was a pretty messy number, which included a number of write-offs or write-downs. And we saw the earnings come in, I think, at around $450, where the market was expecting somewhere between 700 to 800 from memory. But if we are getting to an inflection point here where CIMIC have cleaned up, some of the balance sheet issues and the write-down of asset values, providing cash flows from new projects can can improve, that will be the number that we're keeping an eye on. There's a point here where, if CIMIC can sort of get through these troubled times, the reconsolidation of the business into focusing on Australia and New Zealand large-scale infrastructure bidding and to some extent Asia as well, should bode well for the next 2 to 5 years for CIMIC. So if they can just get through that inflection point, we would expect to see a new uptrend begin. And for that reason, you want to just keep a close eye on this. Ultimately, if we see a break higher and a pullback, it'll switch back to algorithm buy signals. So we are kind of preempting that breakout at the moment. It is making lower lows and lower highs. But from a shorter term trading standpoint, have a think about the long exposure into this as long as it stays above the average. And I'll draw up a example of an options trade just for us to keep an eye on and revisit on the blog and in next week's recording. Hope everyone enjoyed their Easter weekend, and I look forward to speaking again next week. Thank you.